Hello traders, I'm so happy that so many of you guys loved my OpenAI video on ChatGPT 3 and how we can use that to create TradingView Pine script code. That video did really well, probably because of the success of GPT-3, but you know, I digress. What we're going to be doing today is I'm going to be giving you guys what I think is a really good option strategy that you can use for trading options. You can use for trading futures, spot, whatever you want to trade. And this option strategy, well, really we're just going to be looking at options indicators that indicate to us where will price go, where will the Bitcoin underlying go. So if you don't understand options, this video might not be for you, but you still will probably be able to understand about 80 to 90% of what I say. But if you do understand options, then this video is going to be very helpful for you. Okay, I'm going to remove my video capture so that I can focus on not blocking anything. Now, speaking of blocking anything, as a segue, I want to show you guys these 5 things right here, and starting with blocked trades. A blocked options trade, also known as a block trade, is a large options trade that occurs privately. So basically non-retail. This could be a firm, an institution, just a bigger, smarter trader typically. When you see a lot of block trades, that indicates typical institutional activity. Non-blocked is retail activity, okay? But the 2 I want to focus on today are here and here, because these 2 are some of the easiest sentiment indicators you can use to do anything in the market, really. When people hear option sentiment, a lot of people think of this, the put-call ratio. That's very simple and it's helpful, but to me it just doesn't really help that much because it doesn't really put price into context as much as these do. So let's first look at this. What this is telling me is how many traders on their account are doing single leg or multi-leg option strategies that are betting on price rising or betting on price falling. In the last 24 hours, the last one day, overwhelmingly a lot of people, more recently, have been betting on price rising. Typically, that makes me a little bit more bearish than normal. And I've noticed that a lot of people were taking options trades, betting on price rising, and look what happened to price. Yeah, not surprising. So, as you know, whenever either too many people are on the buy side or too many people are on the sell side, price typically likes to screw them over and go against them. So what I like to do is I like to look at this, whatever time frame I'm on. I want to see, are most people bulls or most people bears? Here we can see a lot of people are bullish, especially in the last week. A lot of traders have been opening bullish strategies. Not surprisingly, what has happened in the last 7 days? Not the best for the bullish traders, to be honest. Yeah, not good. If you were bullish starting here, this is kind of a gut punch, So this is something you can look at in the short term as well to see short-term sentiment. A lot of people are buying options, betting on price rising, which again is just a simple contrarian indicator for me to be bearish. I would say that's my second favorite indicator of this entire thing. The best indicator is at the bottom by a long shot. This is super helpful because, it gives away a lot of information on Deribit. What this is showing, guys, is how many option traders are using, or how many contracts worth of people betting. I'm not phrasing this well, but are people more betting on volatility rising, bullish, or volatility falling? This is not price. These are people trading volatility through different options plays. As you can see, most people are bullish on volatility, which typically rises implied volatility. Now, when we see this, that would make me very bearish on volatility. Why? Well, if a lot of people are bullish on vol, typically what happens is volatility will increase. When volatility increases, it gets to a point where it doesn't always represent what the realized volatility will probably be, making premiums overpriced, i.e. Implied volatility is overpriced. And if we look at this throughout some time, the 1 month has been pretty, really nothing too spicy there. 1 week, most people are actually betting against volatility. I actually was lucky enough to see this and to bet on volatility increasing and basically betting on a lot of price movement. And if we look at the last week, this has definitely been volatile. If we go top to bottom just of range, a 9% range is I would say decently, that's not a shy amount of volatility. That's actually a decent amount of volatility. And most people are betting on no volatility. So when I saw this, I was like, well, okay, volatility will very likely increase because typically most traders in the market are wrong, and volatility did increase. Here, a lot of people think now that volatility is going to just keep increasing. Like, look at this. This is making me just want to sell as much premium as I can. Now, you might say, well, Bennett, it's kind of hard to short volatility sometimes, even when we see a lot of people buying volatility. Well, one strategy there's a lot of strategies you could do, but one slightly bullish one is a covered call strategy, where I hold Bitcoin at spot and I short a call. And if you do this, you really only want to do this when implied volatility is high, because you don't want to be doing something such as shorting a call and, buying spot Bitcoin if everyone else is shorting, and also if implied volatility is at like 20%. That's probably an awful time to short volatility 99.9% of the time. But if a lot of people start buying volatility and you see that a call contract at the money, might have implied volatility in the 50s, then that could be a very attractive sign to potentially, go against everyone else and to short the call. So I love this indicator a lot. Basically, this tells us just a contrarian amount of, as a contrarian, it tells me which way should I be betting. And this makes me want to short volatility using covered calls, or using even something such as a Christmas tree spread, also known as, what's the other name of it? Butterfly, also known as a butterfly call spread. Yeah, that's the word for it, butterfly call. Those are some good strategies that you can do with that, and you get it here. So those are some very simple indicators that you can use. You can adjust their time frame as much as you want to give you some good direction. Now, if you want the bare bones simple, this is what I'm about to tell you is not what you should do, but if you want bare bones simple on what's probably not a bad idea, if you just look at both of these and say, are most people buying or shorting volatility? Most people are buying. Okay, probably good to short call or put. Are most people buying calls or buying puts? Most people are buying calls. Okay, probably good to short a call. Just like that. I mean, that's very, very simple, but that would be going against the crowd. And, I think shorting a daily call of expiring at 17K would probably not be a horrific idea, but yeah, that's a quick strategy you can do. Now for the options traders who want something a little bit more complex, I'm going to show you guys an inside look at what I do, not to gauge, is price going up or down, but to gauge where will price go. And that's going to be these next two indicators that I find very, very helpful. Let's start here. So what this is showing is something that you're probably not familiar with, because not a lot of options brokers will ever give you this kind of information, because it's very, very, very helpful. This is telling me open interest changes over the last 24 hours by calls and puts, net delta, a net change. So let me just basically tell you what this is and how you can use it to your advantage. I typically take a contrarian approach with this. Just keep that in mind when I explain. When we see a lot on the right side, that means that there is a massive surge in people entering into options contracts, entering into options instead of closing options. So as you can see here, a lot of people are opening options. When you see a net loss, that means that more people are closing options at that price than opening. Okay? So you can see here, the very, very high call options, very, very expensive calls, are all being exited. So people are becoming a little bit less bullish at the extreme. But in the medium term, people are becoming, a little bit more bullish. You can see all this call activity here. This is not how you should view this indicator, though. What you've got to do is to narrow it down to 1 or 2 expirations, because this is going to give you the information that you really need in order to trade. So if we look here, I can see that most people are not closing trades, most people are opening trades. Now, this is something you can do to get a max pain approach. Where, if price settled over, today and tomorrow, what price would cause the most pain? Well, most options traders are long, as many know. So the most pain would come from the Bitcoin expiring at the strike price that has the most open interest. There's been a massive surge in open interest at the strike prices of 16,750 on Deribit and 17K on Deribit in near-term options. What that tells me is that price is very, very likely to expire in between these two strikes. Because if it does expire in between these two strikes, then most people are going to lose money. And that's probably what's about to happen. Now let's take this one level a little bit further beyond just max pain. Let's look at increase in calls and increase in puts respectively. Another max pain strategy that I really like is looking for the basically intersection or where most put opening turns into call opening. So when the red turns green, basically, as we go vertical, if that makes sense. So most people are buying puts at the lower strikes out of the money. That makes sense. That's just a strategy most people do. You know, you get it. A cheap put can make you a lot of money. A lot of people kind of fall for that. And then what we can see here is a lot of people bought puts. More people opened put positions at 16,750 than people who had opened call positions. That means that a lot of people are betting on price falling below 16,750 over the next day, meaning it's probably not going to happen. Meaning that it could happen, but price will probably not expire below that price. If we look here, a lot of people are buying puts at the 17K strike. A lot of people think that price will stay below 17K and expire below. This is making me think that price is going to expire at around 17,000 over the next day or two, because that would cause the most pain to overall open interest, and also that would cause a lot of pain to anyone who had bought any of these options. They're all going to lose all of their money. They're all going to lose all of their premium, essentially. And if price expires exactly at 17K, that would be very brutal, because that would basically mean that anyone who had bought any of these put premiums are going to lose all their money. And then it would also mean that all the people who bought calls up here are going to lose all their money. So the way that we like to use this is look for where the red begins to turn green. That's where the max pain is and where most options traders will lose money. Also look for where the largest amount of open interest is, because that can tell you where price will likely expire. This is a great gauge for finding out where is Bitcoin going to go over the next day, over the next day or two. You can even make this more pinpoint and just do, the 17th. And this contract expires in 11 hours, so you can see that, you get it. Now for the most complex indicator, probably in all of options, that I'm going to show you guys today. But also with complexity comes a lot of alpha, a lot of edge, and a lot of things you can take advantage of. So if you got it this far in the video, congrats, because you're about to see something that is beyond powerful. And took me a while to understand, but when I began to understand it, I was like, whoa, this is very, very helpful. Let's go through each one of these, okay? I don't think I need to explain any of this. These are just people buying and selling calls and puts in the, with market orders. I think you guys get what this means. It's just people trading calls and puts. Let's talk about this other four right here. So these are block trades. These are large, typically institutional, non-retail trades. People who know a lot more than me and you. When I see a lot of these, I typically want to copy these people and trade against these people, because these are retail trades. Calls buy, calls sell, yada yada. Retail. Blocked is institution. And I prefer to have my money on institutions rather than retail. So let's go look at just only two things to make this a little bit simpler. What have traders been doing with calls? So if we look here, where did very large traders buy calls? This is across all expirations, but you can see it right here. Let's change this though to make it a little bit more pinpoint, just the next day or two. Oh, did it get angry? It got a little bit angry. Looks like no large traders are trading these next few expiries. Oh, do we have one on the 23rd? Cool. So we have. Oh, that's very interesting. For the contract expiring on December 23rd, a very large position of 60 Bitcoin. Someone bought a 17.5K strike, basically betting on price expiring above 17,500. So there you go. But let's go back to. I'll just go back to this to see if anyone did any block trades. Blocked. Let's see here. Blocked. Okay, so of all of the block trades in the last 24 hours of expiries soon, the only one that people have been doing, and this is fascinating, completely fascinating. Wow. I wonder if, do you guys know what this means? What this basically means is that the only large trades that any smart option traders have been taking has been buying puts in the last 24 hours. And look what price has done. Price has fallen exactly to, kind of where they had thought. A large trader or multiple large traders bought 17K puts and did not sell any options, did not sell any puts, just bought a lot of puts at 17K and bought these puts as well. This was probably a smart trader who was in the know, and I think that copy trading this person would have probably been a pretty good idea once you had seen that they had bought a 17K put. Okay, so now that you know, okay, why is it, okay. Is there any way to make this like not freak out? Okay, thank you. This looks so much prettier. Awesome. Except the strike prices all look kind of like jumbled together, but I can still get them by just hovering, I guess. So yeah, I don't like to look at this as, all at once really, because it's kind of hard because there's so many different colors. But what I recommend you do is first do what I did and look at what the largest traders are doing. They're buying puts. Probably not a bad idea to trade with them. Now let's look at what the retail traders are doing across different strike prices. If we start with what retail traders are doing with calls, I can see that a lot of retail traders are buying calls at 17,500. These are very likely never going to make any money whatsoever because price is expiring in these two expiries. Let's just go down to this. I mean, this is just showing you a very easy indicator for you how you can trade like a great options trader, how you can trade like a whale. Buying the 17K put when that person had taken that trade, and then even shorting the 17.5K call, because so many retail traders were buying the 17,500 call, so many retail traders were buying the 17,250 call. When we get to 17,000, it's pretty 50-50. A little bit more buying calls, but it's more or less 50-50. And if we go to 16,500, most people are buying, 16,750, most people are buying calls. So as you can see here, retail traders basically do the absolute opposite of what they should be doing. In counter trading these retail, just regular orders, it typically works out pretty well. Now let's finish this off with looking at what the put action is. So let's go look at where are people selling their puts, where are people buying their puts. So it looks like a lot of people shorted puts at 16,750. Means that if price went below that, a lot of them, would be hurt. A lot of people shorted puts at 16,500, meaning if price went below, then a lot of them, as you can see, would be hurt. This doesn't really tell me too much because it's pretty uniform. There's just not much, really to see from this. People aren't getting that crazy besides a lot of people who shorted puts, which makes me a little bit more bearish. But if we look at all of this in conjunction after analyzing all these retail trades, unfortunately, it looks like retail is very bullish, which makes me a little bit more bearish over the next day or two. Just a little bearish. So I think price expiring anywhere below 17K is probably on the table because just of how this looks. Also, if you want to just ignore anything that retail traders do, which might not be a terrible idea, and just look at what the big guys are doing, go to block trades. And, if we go to last week, well, actually, this only shows the last, 24 hours of trading. But copying these guys has typically been a pretty good idea. As you can see, a lot of people are buying, is that put buying? Yeah, a lot of people are buying puts at 17K, and there was that one guy who bought that call at 17.5. So these are some things you can copy. Okay, so let me recap what we've covered so far, because this has been a bit of a long video. So we've covered the BTC spot bullish and volatility and how we can use this to counter trade against retail traders. What we also looked at is, let's go back to here, is looking at changes in open interest to look at what can Bitcoin do to hurt the most people possible. Finally, what we looked at is segregating between retail traders, which is just regular orders, and looking at block trades that are private, large trades that occur, not directly in front of you, and trading with these people and trading against retail, as you can see here. One final cool thing you can do, this is probably a little bit too complex, but there is a way where you can predict where options traders will get liquidated. What you do is you look for an increase in open interest, and you look for have people sold options at those prices, specifically has retail. So if we look here, this shows us all of the sells, who sold puts and who sold calls, right? Now what we can see is where are most people opening positions. It's at 17K and 16,750. So as you can see here, a lot of people open positions at about 17K, 16,750. Now a lot of these positions were calls, which means that, you know, it might have already done this, but price dipping, like it kind of has probably liquidated some of these people. But what you can do is basically just look for a large increase in open interest. If you want to get very, very pinpoint, you could do something like this, where you could say, okay, so where are most bad retail traders selling options? Well, a lot of them are selling the 16,750 put. A lot of them. Now, what's happening at 16,750 with open interest? It's a big increase, which means that a lot of these selling puts are retail traders opening short put positions, which would make them liquidated if price was to fall. So that's a cool little way you can predict people's liquidations by looking at open interest change and looking at what kind of trades that these people are taking and comparing it to open interest. So that's going to do it for this video. There's a ton of alpha to unpack in this video, so I would hope you would watch this again, to take notes or just to look at different things. If you have any questions, the best place to find me is on my Discord, and the second best place is probably the YouTube comment section. So with that, happy trading. I hope this was helpful, and be on the side of institutions and not retail.